Hello and welcome to Rise Eyes YouTube channel. My name is Devuto Shaha, and in today's deep analysis video, we have a quite interesting topic for you. Interesting in two sense because we have deviated this time from our regular idea. Every day we bring you an article from the Hindu newspaper, but today that is not the case. We have brought an article from Indian Express, which Rice IAS team has felt is quite important for an aspirant to know. Therefore, we have marked all the important facts which are scattered in the article in isolation and have collected all those facts and sum up and presented in this form of article for the aspirants so that they get a one-stop solution. And yes, if a question from this article ever appears, they are able to solve and pretty able to handle that question quite easily. Next, when I'm speaking that if a question ever appears, therefore a UPSC mains model question is in front of you. The question goes, the challenges before the RBI is not longer confined to balancing inflation and growth alone. Examine in the context of rising external sector vulnerabilities and global economic uncertainties. 15 marks. By the question, we have got a fair idea what is today's topic. The topic is between government and RBI. The core idea is getting back the investor. The same title which the article has used. In this article, we are going to discuss about the inflation in India, its effect, its backdrop, why it is happening, why this inflation is more challenging, what are the steps that RBI is taken to counter those challenges, what are still challenges left, challenges ahead, what going to be its way forward, and a conclusion. Then let's get directly started with the context. We know there is rising tension in West Asia, which is directly affecting the crude oil prices. And India is importing around 85% of its crude oil. Therefore, we get to see an inflation risk which has emerged and have re-emerged. Not only emerged, it has re-emerged multiple times because of oil prices. And above that, a monsoon uncertainty this year. El Nino. The second is when the inflation is being imported, there comes a very important question for RBI as to whether it should lower the inflation rate, which will again hamper the growth, or it should let the inflation continue so that we get to see a cascading effect on growth or a virtuous effect on growth in short term. Growth remains vulnerable. At the same point of time, in long run also, we will get to see there is also an indirect effect on the growth if the inflation is let free. It will again affect the consumption pattern, the savings pattern of the citizens. And at last, consequently, the RBI is increasingly focusing on protecting external sector stability and investor confidence. Why? Because as we are speaking, the inflation is imported inflation. So if it is imported inflation, it is very much important for us to protect or to ensure that there is external stability. Now, once the context is set, let's now deeply understand why this time RBI is having a policy dilemma. The first is inflationary pressure. As we know, the core idea or the core work of the monetary policy committee is to control the inflation under the stated category. This time, a higher crude oil prices are increasing the imported inflation, which is again aggravated by a El Nino may weaken monsoon performance and raise food inflation. Already due to crude oil, we get to see an imported inflation. For now, because of El Nino, weak monsoon, we will again see more aggravating effects of inflation, which will affect rising food and fuel prices, can trigger broader inflation. Now, a question for you is that whether food and fuel prices is considered in core inflation or not. You should write your answers in the comment section. The next would be RBI has revised its inflation projection upwards. Because of this, we get to see RBI has revised its inflation projection to upward. Now, the second part, the second dilemma, the first and the second dilemma, the growth concern as I was speaking of. Elevated energy cost can again reduce the consumption and investment, as in short term inflation might have a positive effect on growth, but in long run it will always have an inverse effect. Second, weak monsoon again will suppress the rural demand. Global slowdown may reduce the export demand, and excessive monetary tightening could weaken the economic recovery. Why excessive monetary tightening? To somewhere control the inflation. As a result, we get to see RBI faces a difficult trade-off between controlling the inflation and supporting growth. Supporting growth, which is the core idea of the government. Now, because of this dilemma, what is actually RBI doing? Before knowing what actually RBI is doing, we must see why external sector stability is becoming the real concern now. Why is it that a internal problem is being linked with external conditions? The first, as I would re-emphasize again, this inflation is an imported inflation. Therefore, impact of rising oil prices have multiple effect on our crude oil prices. One, it will increase our import bill, which will affect our trade deficit, widening of trade deficit. The more we pay for the crude oil, more we get to see there is a wider trade deficit and an increase in current account deficit, which creates an effect or pressure on Forex reserve, because the higher crude prices requires higher amount of dollar. The more demand of dollar will equate to more or less supply of money. More supply of money and less demand of money, which will again relate to weakening of rupee. Now, once you have understood why the external sector stability is so important, what is it RBI doing now? RBI is somewhere building the investor confidence. Why does it build investor confidence? Why the investor confidence is that much important for India and RBI? It somewhere ensures that there is a stable capital inflow, which will again support my weakening rupee, and at the same point of time will close the gap or will fund me for all the things which all the crude oil I'm purchasing at the higher price. Second, it will ensure that I have an adequate Forex reserve, which will indirectly help the rupee. It will stabilize the rupee. It will stop further weakening of rupee, and it will reduce the external financing risk also. as when the excessive amount is available in the country, the companies and the borrowers don't have to go outside to borrow money in a situation like in an unstable situation like this, which will help in overall preservation of the macroeconomic stability. Now, once we have understood why the external stability is important, why investor confidence is real to external stability, and why is it so important for India, now let's see what are the strategies that RBI is taking to restore the investors confidence. The first would be somewhere debt market reforms. We see a expansion of full accessible route FAR, easier access to government securities, which we see GSEC, and greater participation of FPIs. The next question would be for you, what is the basic difference between an FPI and FDI? What is that percentage which distinguished a FDI from a FPI? Which will have a higher capital inflow, which will reduce the borrowing cost and have a deeper bond market. Second, equity and NRI investment in the banking segment. We see relaxation of investment norms for NRIs and OCIs, overseas citizen of India's, easier participation and overseas investments, which have a diversified and stable source of capital for both the borrowers, for the companies. At the same point of time, RBI is also ensuring there is foreign currency inflow. It has encouraged FCNRB deposits, support of foreign currency mobilization, which will help in higher forex liquidity and a stronger external buffer. Now the important question is that, is all those things which RBI has taken, will it ensure that we are safe from this imported inflation? The answer is no. Then what are the challenges ahead, which the article also mentions, that we will see under the section of challenges ahead. The first would be the persistent food energy inflation. Even if we somewhere stabilize the external sector and bring confidence among the investors, the weak effect on monsoon by El Nino will never be affected by all those things, which will have a persistent food and energy inflation even if we somewhere control the energy inflation, which will lead to weak rural demand and fragile growth. As we know, most of the agricultural products are largely demanded by the rural section. Rising crude oil prices and geopolitical tension, as we speak, the tension is been more and aggravated. It is not been reduced. So even if we have a stable, a confident investor, we will still see the situation is worsening. Global financial volatility and potential capital outflow is in place. And at last, we see structural dependence on imported energy and foreign capital. The most important aspect of this challenges ahead is that even for the energy and for the fund, we are somewhere dependent among the rest of the India, outside India. Even if we have stability and confidence in place, that will not ensure a sustainable fund or a sustainable energy in future. So what is the way forward? the way forward has been divided into three parts. The first would be short term, medium term, and long term. Under short term, we will see maintaining a calibrated monetary policy stand, which will again help to minimize the effect of inflation and have a positive effect on growth. To monitor the inflation and oil prices trends very closely, so that even the slightest change in any of the situation, RBI can proactively act on that. And maintaining a adequate forex reserve is very much important for us, so that we are able to sustain or able to import all those crude oil that is required for growth driven society. The mid-term way forward would be, medium term way forward would be diversify energy sources and expand renewable resources, so that eventually we move into a non-imported energy supply, improve export competitiveness, so that not only we minimize our import, we should somewhere increase our export and make our product more competitive in the global market. Deepening of domestic bond market, so that our domestic bond market is adequate to handle these kind of shocks and we are not dependent upon the external sector. And last, encourage long term capital inflow through FDI, so that these kind of short situations don't affect our long term progress, and the investor have a clear picture in their mind, so as to have a better effect or a better result or a better return in long term, which will have positive effect on both India and investor, for the investor. And in long term, the very important part, we should reduce dependency on imported energy, build a stronger external sector resilient market, and improve productivity and investment led growth. Because of any situation like this, natural situation which adversely affect our agriculture, we have a agricultural shock proof system. Now, once we have discussed the way forward, now let's discuss the conclusion. The conclusion would be the RBI's policy reflects the evolving nature of macroeconomic, the reality, the macroeconomic management, where external sector stability is becoming an important in inflation control. In earlier situations where the external stability was not that important for India, but in today's time, when increase of globalization or globalizing tendency, it is pretty much important that there is a stable external sector, so as to stable India, for a stable India. Going forward, sustainable investors confidence, sustaining investor confidence, stable capital inflows, and external resilient will be very much critical for ensuring a durable growth and macroeconomic stability of India. With this, I would conclude today's discussion, and I hope that after today's discussion, you are able to solve this question by your own. And yes, if you are wondering from where you can get this PDF, you can get this PDF from RISE-IAS website. And one last thing, if you think this video was helpful for your preparation, I would like you to like this video and subscribe to RISE-IAS YouTube channel. Thank you once again.